Hey everyone, welcome back to another dividend investing video. Today, we're going to have some fun building a hypothetical dividend growth portfolio. And one of the objectives here is to ensure that we are getting dividend income every single month, January through December. Doing so in a way that has us nicely diversified to build up a stream of passive income that should grow and snowball year over year. Building a dividend growth income portfolio is my preferred way to build wealth. Maybe you are a new investor who is looking to start a portfolio as a way to retire early. And here I give you an example of just one way to go about doing so. Or maybe you are a seasoned dividend investor, a regular subscriber looking for some new ideas. Either way, let's get right into it. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. So for this portfolio, hypothetical portfolio, the first point I'm going to convey is it's geared more towards dividend growth than dividend income. It assumes that your goals are focused more so on total growth than income today. The income the portfolio generates, you'd likely be reinvesting as a means to continue to grow your ownership in these dividend-paying companies. Now, I have another video coming in this series that's going to consider a portfolio geared more towards income today, assuming you wanted to live on that income today, where the yield of the portfolio would become more important. But for this video, this hypothetical portfolio, I'm going to prioritize the dividend growth over dividend yield. A few of the stocks I pick pay a smaller yield, but remember, this is for building out a dividend portfolio that you'll collect income from someday. And so the idea here is to pick stocks that yield whatever today, but long-term will provide a solid yield on cost metric of your initial investment, while also providing consistent gains on your invested principal. It's total growth, right? The portfolio today would be more for someone with a 10, 20, 30 plus year horizon on their investments. Since the goal here is to collect dividend income every month, however, and to try to do so in a balanced way, I'm going to construct this portfolio with 12 stocks, one to represent each month of the year. I'm not suggesting the dividend payment schedule is something that we should put this much importance on, but I do understand the desire to make sure that the income coming in every single month is somewhat balanced. And I'm not suggesting anyone go out and buy this exact portfolio. It's more meant to convey a strategy and should be thought of for educational and entertainment purposes only, okay guys? And I think it's just kind of fun to build out hypothetical portfolios like this. So what kind of stocks am I picking for this portfolio? There's a few criteria I'm looking at. The first is dividend growth. I want to invest in compounders. I'm looking for a 5-year average annual growth rates, hopefully in the double digits or high single digits. Again, I don't really care what the yield is, whether that's 1, 2, or 3% for right now. My second criteria is I need to be able to understand their business. I try as much as possible to stick with companies I'm familiar with, companies I'm a customer of, companies I use in my day-to-day life. If I can't explain to my 12-year-old daughter how the company makes money in a way she can understand, I probably should be investing in something else. These are companies I plan to stick with for the next 10, 20, 30 years and beyond, so I want to like where this company is going in the future. And do they have a moat? My third criteria is I want a safe dividend. Now, nothing is a given in the stock market, anything's possible, but since I have the subscription to simplysafedividends.com, they provide nice dividend safety scores here on some set criteria, so I only picked from stocks they rate as safe or higher. Generally, you want the dividend to be easily covered by free cash flow, and you want free cash flow per share growing year over year. That is the recipe for dividend growth. Since this is 12 stocks, not doing a deep dive here, we're just going to cover these real quickly, and then I'm going to get out my spreadsheet to show you a hypothetical portfolio constructed in this manner, and even a dividend calendar that shows you how you would expect to get paid with this portfolio. Here they are. For January, I'm going to go to the communication sector with Comcast, ticker CMCSA. Shares of Comcast yield 2.72%. They have 14 years of consecutive dividend raises with a 5-year average dividend growth rate of 11%. Their most recent dividend hike was a 7% increase. Simply Safe Dividends gives Comcast a safety score of 89, so that covers us for January. For February, let's go to the consumer discretionary sector with Starbucks, ticker SBUX. The largest coffee retailer on the planet. Shares are yielding 2.32% right now. And Starbucks has 13 years of dividend growth with a 5-year average annual dividend growth rate of 10%. Their most recent hike back in September was a 7.5% raise. Simply Safe Dividends gives Starbucks a safety score of 67, so Starbucks has us covered for February. For March, I'm going to go to the financial sector with Aflac Incorporated, ticker AFL. Shares are yielding 2.41% at the time of publishing, with 40 years of dividend growth and a 5-year average annual dividend growth rate of 13%. And just last month, they announced their latest dividend boost at a whopping 19%. Simply Safe Dividends gives Aflac a dividend safety score of 99. So Aflac has us nicely covered for the month of March. How about for the month of April? I've chosen one of the top dividend growth stocks in the industrial sector, so that's Automatic Data Processing, ticker ADP. Shares today are yielding 2.4%. ADP has been growing their dividend for 49 years with a 5-year average annual growth rate of 14%. Just last month, they announced their 49th dividend raise at 12%. Simply Safe Dividends gives Automatic Data Processing a dividend safety score of 97, very safe, and that has us covered for the month of April. For May, let's move on to healthcare. I'm going to look at the biotech company AbbVie Inc., ticker ABBV. Shares are yielding 4.1%. And if we consider their history pre-spinoff from Abbott Labs, they have 51 years of dividend growth, 5-year average annual dividend growth rate of 17%, but their most recent raise back in October was on the lower side at 4.7%. Simply Safe Dividends gives AbbVie a dividend safety score of 70, and that takes care of us for the month of May. For June, let's invest in semiconductors, one of the top performing dividend growth stocks for the last 5 years. I'm talking about Broadcom, ticker AVGO. Shares of Broadcom are yielding 2.04%, and Broadcom has been raising their dividend for 13 years with a 19% average annual dividend growth rate. They just announced their latest raise a few days before recording this at a solid 14% raise. Simply Safe Dividends gives Broadcom a dividend safety score of 67. And with Broadcom, we have June covered, and that's half of the year, half of the portfolio already picked out, and half to go. So for July, let's diversify into some real estate. How about American Tower, ticker AMT? Shares are yielding 3.15%. This is a real estate investment trust with 10 years of consecutive dividend raises and a 5-year average annual dividend growth rate of 17%. In the last year, the dividend has grown by 12%. AMT is awesome that they raise this dividend multiple times a year, often every quarter. AMT has a dividend safety score of 78 from Simply Safe Dividends, and that will have our portfolio covered for July. For the month of August, let's go to the financial sector again and invest in MasterCard, ticker MA. The payment transaction processor is yielding 0.64%. Not much yield, but check out the dividend growth. We have an average annual dividend growth rate of 18% over the last 5 years. And just the other day, their 12 consecutive dividend raise was announced at 16%. This is more of a total growth play, locking in a solid yield on cost. Shares are up 408% over the last 10 years. This has been one heck of a winner, and shares bought 10 years ago have a yield on cost of over 3%. Simply Safe Dividends gives MasterCard a dividend safety score of 99, so that has us covered for the month of August. For the month of September, how about consumer staples? Right now, I like Hershey's, ticker HSY. The chocolate maker is yielding 2.56%. They have a dividend growth track record of 13 years. Their average annual dividend growth rate over the last 5 years is 9% per year. Their raise back in July was a 15% boost. Simply Safe Dividends gives us a dividend safety score of 93, a very safe dividend, and that makes our portfolio covered for the month of September. Then we go to October. Let's go to the pharmaceutical giant Merck & Company, ticker MRK, yielding near 3% and with a dividend growth track record of 11 years, featuring a dividend growth rate of 8% on average over the last 8 years. And their latest, just last month, was at 5.5%. Simply Safe Dividends gives Merck a safety score of 99, a very safe dividend, and with that, we are good for the month of October with Merck. For the month of November, how about home improvement retailer Lowe's Companies, Inc., ticker LOW. This is a dividend king yielding 2.13% with a track record of 62 years of dividend raises and going strong with a 5-year average annual dividend growth rate of 20%, although its latest raise back in the spring was a smaller 4.8%. Simply Safe Dividends gives Low a very safe dividend safety score of 93, and I think it's an excellent choice for our November pick for this dividend growth portfolio. And finally, for the month of December, let's go to the information technology sector, one of the mega cap tech giants. I think Microsoft is the way to go for this month, ticker MSFT. What they lack in yield, they make up for in total growth. Shares are up nearly 900% over the last 10 years. And if you had the wisdom to hold on these shares for 10 years, your yield on cost would be 8.10%. That is amazing. Microsoft has 13 years of dividend raises, and the dividend has been growing at an average rate of 10% over the last 5 years. And they have no debt and a AAA credit rating. I think we can trust the SimpliSafe dividend safety score of 99. And that wraps up our portfolio construction, covering us for the month of November. So let's see how this looks as a portfolio. All right, so here's how $10,000 invested equally between these 12 companies would look, where you have roughly $833.33 worth of each of the 12 companies I just listed out. Of course, I've built a spreadsheet out here in Google for this. The yield on the portfolio would be 2.33%, so that's not super impressive if you're looking for income now, but that's not the goal of this portfolio. And check out the average annual dividend growth rate. This is based off the last 5 years. This group averages almost a 14% dividend growth rate, and that's pretty awesome. If you had held this portfolio over the last year without doing anything else, the income generated would have grown by over 10.5% in the last year just from doing nothing. And that doesn't even count dividend reinvestments. Now, is it realistic to think all these stocks can keep growing at double-digit rates? Probably not, but it is reasonable to see these settle into the mid to high single digits over the next decade, perhaps for some of these. This is a starting point. So if you have $10,000 worth of these 12 stocks, you're making roughly $233.45 in annual dividend income. But since we don't need to use this $200 some over the next year, this would just be reinvested back into the stocks. And for a small portfolio like this, it actually makes sense to let these drip or automatically reinvest. It is also reasonable to assume that since each of these companies have the track record of raising their dividends every year, that at this time next year, the annual dividends these companies are paying are going to go up. We don't know what their share price will be and what's going to do in the short term. They could drop, they could soar. But that dividend income, that's a little easier to predict. And I think a portfolio constructed like this, you can start with $1,000, $500, hell, even $100. And that's the beauty of being able to invest in fractional shares. A portfolio like this, you can just keep adding to every chance you get, 100 here, 100 there, and it really adds up. And I think my own portfolio on this channel is testament to that. Now let's say we have a little more money in the portfolio, go $100,000. How's that going to look? At that level, with a 2.38% yield, we're bringing in roughly $2,334.53 of dividend income. This is nearly $200 per month. And that's really something, right? Well, it's not going to retire you and pay all your bills. It's a heck of a start to have you well on your way. And since I constructed this with a balanced payout schedule, this will pay us every single month. Now let's see how that looks. We have months as low as $167 and months as high as $255. That's a pretty decent balance here because we constructed this to make sure it's paying out every month. And one of the reasons you hear folks in the investing community preach getting that first 100K invested, well, just look at the dividends you're bringing in. $2,334 in dividends reinvested. That's like adding an extra $200 a month into your investments. It just helps you compound even faster. And of course, the more time you have for compounding to do its thing, the better, which is why I advocate starting as soon as possible with just whatever you can do. Now, one last thing I want to look at, starting with $1 million invested. How would that look? So this would give me $83,333 worth of each of these 12 stocks roughly, and it would pay me $23,345.31, or just shy of $2,000 per month. Now that's pretty damn significant. And if you don't need to live on these dividends just yet, well, then you'd be reinvesting $2,000 every month. And this is the dream. This is the position you want to get yourself in. Now let's look at how that would pay out. We have months of $1,700, months of $2,500, but we're averaging $2,000 per month. Of course, if I had $1 million and say I wanted to live on that income right now, I wasn't going to reinvest it anymore and I wasn't concerned with total growth, I want the income today, then I'd be building a different portfolio than the one I have right here. And I'll go over how I'd construct a similar portfolio centered on dividend income in the next video for this series. So make sure you're subscribed for that, because you could make $1,000. That could go pretty far, but you have to consider capital preservation and dividend safety. Now, guys, let me know down in the comments if you put any weight onto what a dividend stock pays out. Do you care? I personally do not, but I get those that do. So I thought it would be fun to construct a dividend growth centered portfolio with that in mind, picking one stock for each month, and I hope you enjoyed. And my friends, if you want to follow along with the actual dividend growth portfolio that I am building, which includes some of these exact stocks, go ahead and click into this next video where I summarize all of the portfolio activity for the month of November. And if you enjoyed this video, I think you're going to enjoy this next one as well. Thanks so much, and until next time, keep investing.